Looking ahead to another interest rate cut in the UK. Good morning and welcome to Morning Markets. Last night, the Federal Reserve in the US left interest rates unchanged, gave no indication of an imminent cut in interest rates, but revised up their risks to both inflation and unemployment. By contrast, the Bank of England are expected to cut interest rates by 0.25% to 4.25% when they meet today. This would take total easing in the current interest rate cutting cycle to 1%, but there's scope for significant further cuts in the months ahead. Only a few months ago, the Bank of England were justifying a relatively slow pace of interest rate cuts on concerns about services inflation being sticky and upward pressure on wages. However, developments since then have been a source of comfort for the bank. Inflation risks have subsided and downside risks to growth have increased. The sizing and timing of US tariffs are unclear, but any tariffs on China is likely to result in cheap Chinese goods being diverted to the UK among other countries. In addition, a sharp fall in oil prices and the strength of sterling in recent weeks is a source of disinflationary pressure. On growth, even if tariffs are rolled back substantially, global trade and growth will take a hit and the UK is not immune. The Bank of England now have a green light to cut interest rates at a more rapid pace, and this should support a decline in bond yields. We continue to favour gilts among sovereign bond markets as offering a relatively high yield, a decent chance of capital appreciation and good diversification for equities. Any reduction in the pace of the bank's programme of selling back the gilts that it bought under QE would be an additional bonus. Thank you for listening.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.